One of the beauties and, of course, a contributing factor to the success of a hedge fund is the strategies used in the hedge fund. These strategies are so important that, when overlooked, they can cause lots of damages to a hedge fund. Thank you very much for clicking on this video and welcome to our channel. Before we begin, do us a favor and click on the subscribe button, the thumbs up button, and also the bell icon to get notified about our new videos. Without much ado, let's quickly look at what the hedge fund strategies are and how they can be utilized for a successful hedge fund investment. What are hedge fund strategies? Although they may seem like a very complex concept, hedge fund strategies are quite easy and simple to understand. They are a collective set of instructions or principles that a hedge fund follows and abides by to protect itself against stocks and securities movements in the investment market. These principles also help hedge funds to make profits using very small capital and without putting themselves into a lot of risks or risking their entire budget. Now you know what the hedge fund strategies are, let's quickly move to the hedge fund strategies and how they are used. Market-neutral hedge fund strategy. Permit us to begin with the market-neutral strategy of running a hedge fund. Unlike some hedge fund strategies with the long or short equity strategy that is coming up next, the market-neutral strategy for hedge funds aims at zero net market exposure. In simpler terms, it means that there are two positions, long and short, and these two positions have an equal market value. If this strategy is employed by a hedge fund manager or an investment manager, the hedge fund will produce a full return of investment from their stock portfolio and selections. One good thing about the market-neutral hedge fund strategy is that it poses a lower risk. But then again, when it comes to investments, low risks are often associated with low returns of investments. This fact is written on rocks. In a market-neutral strategy, the gain or loss of any side or positions, whether long or short, in the value of an investment is always offset by the opposite position. Long or short equity strategy. This is a type of hedge fund strategy that involves equity and its derivatives. It also involves the investment manager or the fund manager to manage and maintain long and short positions in the hedge fund investments. That is to say that the fund manager's job is to make investments that will benefit the hedge fund and other investors, proceed to sell the stocks that are overpriced and overvalued, and buy those that are undervalued. To know a detailed and complete job of a fund manager, you can check out our video on how to work on a hedge fund and what it's like. You should note that the fund manager does not just make decisions out of the blue. He employs several strategies. The long or short equity hedge fund strategy involves the application of a wide range of techniques and methods to arrive at a position investment decision. These techniques or methods can either be quantitative or qualitative. This kind of strategy can be used in different settings of a hedge fund, whether it is a broad setting or narrow to a sector. The sectors range in terms of leverage, exposure, market capitalization concentration, stock valuation, and holding. Convertible arbitrage hedge fund strategy. If you have ever heard about hybrid securities, then you will easily understand the concept of the convertible arbitrage hedge fund strategy. The convertible arbitrage hedge fund strategy typically includes long convertible bonds and short proportions of shares into which they can be converted to. If that doesn't seem clear enough to you, then you should understand that convertible arbitrage strategy includes two positions, a long and short position. While the shorts are on shares and common stocks, the long positions are on bonds. This combination between bond and equity options is what is known as hybrid securities. With this strategy, the hedge fund aims to capitalize on the fact that an underlying stock of a convertible bond may be mispricing. After using this strategy, fund managers adopt the delta-neutral position, which causes the value of the investment portfolio to remain unchanged with changes in the underlying securities. This particular hedge fund strategy is dependent on the volatility of the bonds, equity options, or hybrid securities. Merger arbitrage hedge fund strategy. Are you familiar with arbitrage profit? If you are, then this hedge fund strategy will be easier for you to understand. If you are not, there is no reason to worry, as we are here to make it easier for you. In the merger arbitrage hedge fund strategy, the hedge fund manager buys stock from companies that are merging. those stocks are bought simultaneously and sold to create a very low-risk profit. Unlike other strategies mentioned above, the merger arbitrage hedge fund strategy is one of the strategies for hedge funds with the lowest risk. The risk is that the merger deal with these two companies will not close at all, and even if it does, it may not happen on time. You may consider this a little uncertainty, but it sets off a cascade of events that may result in the target company's stock selling otherwise at a discount that the combined entity will have sold the stocks for after the merger was complete. The difference in the price and discount the entity or stock was sold for is known as the arbitrage's profits, and it is used by fund managers to stall price gap opportunities before or after the merger deal is completed. Pretty interesting, right? Capital Structure Arbitrage Hedge Fund Strategy. The next is the Capital Structure Arbitrage Strategy. This is almost similar to the long or short equity strategy, but the devil is in the details. The Capital Structure Hedge Fund Strategy involves the selling of an overvalued security and buying the undervalued ones. This strategy capitalizes on the mispricing of a stock or policy inefficiencies found in the firm's capital structure. Although it is the last on this list of hedge fund strategies, it does not make it any less important. It is, in fact, one of the most used strategies by quantitative, directional, and market-neutral credit hedge funds. The Capital Structure Arbitrage Hedge Fund Strategy deals with a company's capital structures. It may go for long in a security in a firm's capital structure, and at the same time, go short in another security in that same company capital structure. These are not the only strategies that are used by hedge funds. Notable mentions include the fixed income arbitrage hedge fund strategies, the short-only hedge fund strategies, the global macro hedge fund strategies, and others. What do you think? Which hedge fund strategy is better? Do not hesitate to share your opinions, thoughts, and experiences in the comment section below. Also, subscribe to our channel if you like this video and click on the bell icon for more engaging content like this. Check out our other videos coming up right now on your screen.